So maybe I just ask you for your name, where you're from, and what your investment thesis is.
Sure. So I'm Nils Holum. I'm a vice president at Rockwood Equity Partners. So we're a lower middle market fund. I'm based in Denver, but we have offices in Cleveland and New York as well. Like I said, we're focused on the lower middle market, and what we're really trying to do is find companies that are either owner-run or legacy family business that have good businesses but haven't necessarily invested the resources or capital or personnel into kind of some of the basic kind of business functional areas that a lot of other private equity firms require to invest in a partnership alongside folks. So what we're looking for is kind of easy to understand businesses, good niche, good strategy, but they've never had an audit, or they've never counted inventory, or at least they have less sophisticated, where we can basically go in and send an analyst or some guy like myself out there for 3 to 6 months, 4 or 5 days a week, and really work alongside them to professionalize those systems and processes a lot more, such that when we're looking to sell on the back end, we have a wider universe of folks that are interested. And by the way, we've kind of grown the company and executed on the overall business strategy in that time period as well.
Excellent. Well, thank you for that. One of the things we're seeing in terms of trends in private equity is extended holding periods. So we're seeing the holding period last beyond the typical 3 to 5 or 5 to 7 years. How is that affecting your business, and how do you see that affecting private equity overall?
Well, I'd make 2 comments on that. I mean, one, we've seen the same thing. I mean, private equity firms are holding on to stuff longer, and we're not an exception to that rule. I think it's harder for people to find assets that are to put new capital in that are going to earn as attractive of a return as the stuff that they've invested in already. So that's part of it. The other observation that I've noticed, and I've observed this in conversations with my friends who also work in private equity, is that the hold period kind of philosophy really needs to be aligned with limited partner expectations. In Rockwood, most of our capital is from family offices, kind of entrepreneurial guys who are managing to long-term wealth creation. There's other private equity firms that we've come across that limited partners are focused on IRR, and that's how the manager's compensation is based, and that's how the metric that they're using to evaluate how their private equity investment program is going. So I think that in general, yes, hold periods are kind of continuing to extend, but the more salient trend, at least from our perspective, is kind of this what can be misalignment between LPs and GPs on kind of what the right metric to measure the success of the program is. Yeah,
very good. Another thing that's interesting, how you say the GP or LP investors are in part driving the holding period term. We're also seeing an uptick in crowdfunding, and maybe you're seeing that as well. And how do you think that's going to impact holding periods or other investments in private equity?
Well, there's a lot to unpack in that one. Well, I personally have seen an increase in crowdfunding. I don't know if it's impacted the types of deals that Rockwood has looked at so far. I know that KKR has basically a direct-to-retail model where they've hired a fund manager, and they've gone out to solicit accredited investors to basically invest. I don't remember if they're investing in. I don't think they're investing in the deals directly. They invest in the firm's different funds. But regardless of how they do it, I mean, crowdfunding is there's a lot of capital out there among the retail community. There's a lot of capital in the private equity community as it is. So more capital into the retail capital coming into the private equity sector is kind of, from my perspective, only going to sort of inflate multiples and create a different type of investor that's trying to deploy more capital into the same assets. As far as how it affects strategy and the overall market landscape, I mean, it's the average retail investor probably doesn't have the resources to evaluate and to figure out who the right GP is to manage his or her personal capital, and so there is an attractiveness towards. I think if you're a private equity firm and you have the resources to kind of set up a program that's targeting retail investors, it's potentially a good segment of the market that's been historically untapped. And in addition to that, they probably have the requirements from a reporting and from a communication perspective are probably less burdensome than some of the other LPs.
Yeah, maybe I could just ask one more, because you made some comments about companies that might be a little less formalized, that might be a good target for you. What is the time period that you kind of expect to get down the sophistication curve? Is it a 1, 2, 3 year time period where you feel the companies that are up and running in terms of more sophistication, more reliable reporting? What would that time period be?
It really depends. I mean, you know, the plan for us, it really depends, and it's hard to kind of bracket it on or bookend it on two sides. I mean, we obviously, you know, we are a private equity investor, and so our hope is that we're going to set up a program that's in place and has a track record for at least a handful of years before we're going out and trying to achieve liquidity event for ourselves. I mean, if I had to put, I mean, the median time has probably been, you know, 6 to 9 months, but there's probably even a range. There's a range in terms of, you know, the kind of the reporting. We basically have a playbook that we're working with companies to implement, and sometimes that can take, you know, 2.5, 3 years.
Very good. Well, thanks, Nils. Thanks so much.
Thanks,
Appreciate you coming out today.
Okay,
Thanks.
happy to do it.